Hey, good evening, everyone. Marty Missouri here, May 27th, 2022, Friday. Wrapping up the week with our weekly economic update. Going to try to keep it quick. We'll do the usual. We'll look at our graph of our index. I'll talk about the score. We'll go through a handful of the inputs, and then we'll call it a weekend. So in front of you is the graph of our index, and we ticked up just a titch. Went from 8.7 to, call it 11, 10.87. So again, we are not experiencing, in our view, recessionary conditions just yet. We certainly are seeing a slowdown in the rate of growth, but we still remain in the expansion camp. As I've said recently, feels more like your mid-cycle slowdown as opposed to the end of the expansion. But we're open to all possibilities, and that's our assessment based on the data as we see it currently, always subject to change as things evolve, of course. So looking at some of our inputs, personal income. The PCE data actually came out this morning. Mentioned it briefly on the written blog this morning, but we'll start with personal income. Rose at a 0.4% pace month over month, slightly off the previous month, but still growing. Personal spending grew at 0.9%. Again, a bit of a slowdown in terms of spending, but still a very healthy pace. The savings rate, however, is really kind of falling off the cliff, 4.40%. One of the main narratives among what I'll say are bullish economists on 2022 has been the $2+ trillion sitting in consumer savings accounts, and the notion that that will offset the shrinking liquidity as the Fed tightens monetary policy, works to tighten financial conditions, so to speak. I think we are seeing that in the continued consumer spending. We're seeing it in retail sales holding up. But again, we're seeing things move at a slower pace. And clearly people are now saving less, and I'm sure drawing from that savings. And I don't have the chart dialed up here, but we are seeing quite the uptick in personal debt as well. So people are hitting credit cards, for example. Now, whether that's happening for them to continue to spend and have fun, or inflation is becoming such a problem that people are having to do that, to fill their grocery cart and their gas tank. I mean, to some degree, no doubt, it's probably both. In terms of the health of the economy, that you would hope that the former would be the predominant factor. What conflicts with anything that might be rosy in terms of the consumer data, particularly when we're looking at the University of Michigan, which is this green one, and the Langer Consumer Comfort Index, which comes out weekly, this one monthly. Different questions. The Conference Boards is still holding up. It's yet to report its more recent number, but the University of Michigan number today, that drops down to 2011 levels. Literally, the consumer is feeling less comfortable with his and her financial situation than they were at the bottom of the COVID crisis, according to the survey. Getting close here as well. Heavy truck sales have been, somewhat of a bright spot. As you can see, we're losing it a little bit here over the last month. The U.S. Economic Surprise Index, obviously this is a noisy indicator, but it's something we do take a look at. I actually read just a brief comment from an economist who believes we are already in recession. It's just nobody knows it but him. He pointed to this, and I don't really go there with this particular indicator. I mean, we look at it. We don't say it's unimportant. But as I mentioned last week when I showed you this, when it was down 13, now it's down 39, below zero, is what it represents is data that's come out compared to what was forecast by economists. So when economists are optimistic, overly so relative to reality, well, then this shows up in the negative. When they are pessimistic relative to reality, well, then it shows up in the positive. And even as we enter recessions, you can see the COVID recession, we were coming off of negative territory. Right here, we were falling pretty rapidly before the 2008 crisis, and this goes back as far as this indicator will take us in our database, which is 2003. Very noisy, but something to think about and to pay attention to. And it is relevant, we think, but it's not the best of our indicators. But here we are. It's dropped notably over the past few weeks, so worth mentioning here. And then also this morning, along with the income and consumption data, is the inflation data from the PCE, personal consumption expenditures. This is what the Fed looks at. So the headline dropped to 6.2, call it 6.3. Core, which X's out food and energy, 4.9. And then the headline, 0.25% on a month-on-month basis. So, this is absolutely something we've been talking about, that we are structurally bullish on inflation. We think it's going to be higher for longer than what we've grown used to over the last 40 years. But it's not going to remain at 8.5 on the CPI or 6.3 on the PCE. It's going to slow down. There's base effect involved, and then of course this is just a natural transition of things. But we do think that there are enough changes in the economy, stuff that I've written about ad nauseum. Anybody who can't find our longer inflation thesis on the blog, just shoot me an email and I'm happy to send you a link to that. But anyway, so this was absolutely anticipated. We had that big rally in stocks this morning. I talked about it on that brief 6-minute snapshot that I sent out to you a little while ago. The market's reaction this morning to this news, it was immediately higher, but we were really poised to continue to have this kind of counter trend rally. Technically, as I've been pointing to on the charts for the last couple of weeks, we could identify where the buying zone was probably going to occur. This time it actually played out that way. Our upside target is, I think, higher than most of the people who feel that we do, that this is just what ultimately would be a bear market rally. But you can sure see the momentum building. I think a not small influence on that this week was the rebalancing of these target portfolios that rebalanced to the stock and bond mix, every month and every quarter. Over the last month, bonds have been relatively flat while stocks have rolled over pretty hard. So clearly there's billions of dollars of money that would flow out of bonds into stocks just as an automatic for these particular funds, and that provides a bid under the market. Add that to just stark pessimism. I talked about our PWA sentiment index, fear greed monitor we call it. It suggests there's a lot of fear, a lot of bearishness, a lot of people who can change their minds and bid stocks higher. Typically there's a higher short interest in that market that would have to be covered if you get a surprise in the opposite direction. There are dynamics that we don't want to get into the weeds too much here that have to do with the huge amount of options volume that's in this market. So it wasn't hard to, number one, technically point to that 3,800 spot as a place that the market gets bought, or to suggest that maybe it's got legs. Now, we're at the end of the month, and so it's going to be very interesting to see after this whopping big week that really is just the natural bounce after several really ugly weeks. How does that get digested this next week? Going to be very interesting to see. We actually see more upside in the charts, but we're getting pretty close to that target. And if we're right in terms of our overall general concerns that these negative, somewhat bearish conditions have not played themselves out yet, then there's just a little bit more upside to this. I mentioned that this has been very good for our hedging activities over the last week or so. I mentioned that in that video earlier today, but I'm getting kind of off track here, folks. But this data right here of the rate of change of inflation softening a bit added to the bid, if you will, under the market today. What it implies is that maybe the Fed, if this were to continue, won't have to be as aggressive as the market is currently pricing it. As for that correction in commodities, at least illustrated by the Bloomberg Commodity Index, well, that's come and gone, at least at the moment. We're threatening these all-time highs once again. So that kind of flies in the face of the inflation cooling narrative, right? And we think this is an area or a source of consistent higher than long-term average inflation going forward for years to come. And again, this is a thesis that we've really pounded hard on the blog already, so I don't need to go there now. And then lastly, the Chicago Fed's Financial Conditions Index. This is actually 85 different economic data points. Right now, 62 score positive, 23 score negative. So that's a bullish view on the economy. 0.47 is April's reading. Between 75 to 80% of the data points are positive. And by the way, on that subject, and then I'll close, we have 46 data points in our economic index. Right now, 33% of them score positive, 22% of them score a negative, 45% neutral. In this week's change, we didn't get any new positive readings. We went down 2% in the negative and up 2% in the neutral. So again, one more time, we're not living amid recessionary conditions just yet, but this is a mixed picture by definition and something that we need to stay very intimate with and allocate for properly in the construction of our portfolios. So folks, thank you as always for watching and listening. I hope you have a wonderful long weekend and be safe, and I'll talk to you next week. Take care. Bye-bye.